The line was never the signal. Don't lose money. 9 traders out of 10 would draw a trend line, wait for price to touch it, click buy, and then watch the market cut straight through the level like it was never there. And every single time, the conclusion is the same. Trend lines don't work. Here's what I want you to consider instead. The line was never the signal. The line is a map of where pressure is building. The signal is what price does when it arrives. Over the next 20 minutes, I'm going to hand you a complete trendline framework. How to draw a line that isn't just wishful thinking. How to stack confluence so you're only trading the best 2 or 3 lines on the whole chart instead of the 12 you've currently got on there. The bounce play, the break play, and the top-down map that keeps you on the right side of the bigger move. Stay with me to the middle of this video, because there's one small confirmation to trigger a line you draw on the pullback itself. And it is the single biggest reason my trendline entries stopped getting stopped out at the low of the move. Part 1. What a trendline is actually measuring. Price does not travel in a straight line. It travels in waves. A push, a pause, another push. In an uptrend, each push tops out at a higher high than the last, and each pause bottoms out at a higher low. In a downtrend, you get the mirror image, lower highs and lower lows. Those turning points are your swing points, and they're the only thing a trend line is allowed to connect. So the mechanics are simple. In an uptrend, you connect the swing lows, and the line sits underneath price that's dynamic support. In a downtrend, you connect the swing highs, and a line sits above price that's dynamic resistance. Notice the word dynamic. A horizontal level sits at one price forever. A trend line moves, which means the level you're trading tomorrow is not the level you're trading today. That's a feature, not a bug, but it's also why so many people mismark them. There's a second thing the line tells you that most people never read: the angle. A shallow line, maybe 15 to 30 degrees, is a trend that's being accumulated patiently. Those lines tend to hold for weeks. A near vertical line, the kind you get on gold after a surprise inflation print, is not a trend, it's a stampede. Steep lines break, almost always, and the break usually means nothing more than a return to the average pace. Read the angle before you decide how much you trust the line. Part 2. 4 drawing rules that stop you fooling yourself. Rule 1. 2 swing points are the minimum to draw a line, but 2 points only give you a hypothesis. Any 2 dots on a chart can be joined. That's geometry, not analysis. The line becomes tradable on the 3rd touch because now the market has told you twice that it cares about that slope. So when you're scanning charts, mark your 2-point lines lightly and wait. The 3rd touch is where your money is allowed to show up. Rule 2. And this is the question I get more than any other. Wicks or bodies? The honest answer is whichever gives you more contact. Draw the version that touches the most swing points and leaves the least amount of price sticking through it. Sometimes that's a line along the wick extremes. Sometimes it clips a wick and rests on a body. What you must not do is redraw the line to a different anchor every time price disagrees with you. That's not analysis. That's negotiating with the chart. Rule 3. Treat the line as a zone, not a laser. Markets are messy, spreads widen, liquidity thins, a news candle overshoots by 15 pips and comes straight back. If you're trading GBP USD on the hourly, give the line a buffer of roughly 10 to 15 pips either side. On gold, that buffer might be $3 to $5. The zone is where you start paying attention. The line itself is just the middle of the zone. Rule 4, and it's the one that saves the most money. Do not force it. If you're tilting your head, deleting and redrawing, or ignoring a swing point that ruins the picture, there is no line there. A market that isn't trending doesn't owe you a trend line. Some sessions, the chart is a range, and the right answer is to trade the range or trade nothing. The traders who blow up on trend lines aren't the ones who draw them badly. They're the ones who insist on drawing one every single day. One myth to kill while we're here. You'll hear that the more touches a line has, the stronger it is. Up to a point, yes, 3 or 4 touches means the level is respected and watched. But a line with 8 or 9 touches is a line that half the market has already traded, and every one of those touches has stacked stop orders just beyond it. Heavily touched lines are the ones that get swept. Respect them, but expect the break to be violent when it comes. Part 3. Confluence. Turning a line into a level worth risking money on. A trend line on its own is one reason to take a trade. One reason is not enough. What you're hunting for is confluence, a spot where your line arrives at the same time and the same price as something else that traders already care about. When 3 independent groups of traders are watching the same 40 pips, the reaction there is bigger, faster, and easier to read. The strongest confluence partner is a flip level. Take a support level that price broke through on the way down once broken. That old floor tends to act as a ceiling when price comes back to it. Now imagine your descending trend line, arriving at that exact old level. You've got sellers who are short from the trend line and sellers who are short from the flip level, all defending the same few pips. That's a level with weight behind it. After flip levels, the partners I actually use are short. Round numbers. The big figures like 1.25 on cable or 2,400 on gold, where institutional orders and retail stops both cluster. The prior session's high or low, especially the Asian range on a London Open trade, and a moving average that the pair has been respecting, the 50 EMA on the hourly being the obvious one. That's it. 3 or 4 tools, not 30 indicators. Here's a practical habit that will clean up your charts overnight. Grade every line you draw. An A line has 3 or more touches and lands on a flip level or a big figure. That's a line you'll risk a full position on. A B line has 3 touches but no partner half size, or wait for extra confirmation. A C line is 2 touches and hope. Delete your C lines. Most traders' charts are 90% C lines, and that's why nothing on them seems to work. Part 4. The bounce play, step by step. This is the bread and butter trade. Trading with the trend, off the line, in the direction the market is already going. Let me walk you through it as a live sequence on cable, and I want you to notice how much of it is waiting rather than doing. Step 1. Establish the trend. Higher highs and higher lows on the hourly, we are buyers only. We are not looking for shorts today, no matter how tempting that last red candle looks. Step 2. Draw the line under the swing lows and extend it to the right, into empty space. That extension is the whole point. It tells you roughly where support will be in 6 hours' time, which means you can set an alert and go and live your life instead of staring at a 5-minute chart all afternoon. Step 3. Look left. Find the old resistance the market broke through on the way up. If it sits close to where your extended line will be, you've got your confluence zone. Step 4 is the one everybody skips. Price arrives in your zone, and you do nothing. You do not have a buy order sitting on the line, because roughly half the time, price gets to a trend line and goes straight through it, and a limit order sitting there is just a donation. Instead, you watch how price behaves inside the zone, and you're looking for one of 3 tells. Tell 1. A rejection candle. A long lower wick into the zone with a small body at the top. Buyers stepped in aggressively, and the close tells you they won the bar. Tell 2. Repeated failure. 3 or 4 candles, all trying to close below the line, and none of them managing it. Tell 3. And this is the strongest. The sweep. Price dips clean through the line, takes out the obvious stop sitting under it, and then closes back above it, usually with a big bullish engulfing bar. That's not a failed level. That's the level doing its job by clearing out the weak hands first. Now the execution. And I want to be specific, because vague entries are how people lose money slowly. Entry at the close of the confirmation candle, not halfway through it while it's still forming. Stop loss below the low of that candle, plus your spread buffer. If the sweep wick went to 1.2612, your stop is somewhere around 1.2604, not 1.2611. Target the next structural high, and if that doesn't give you at least 2 times your risk, you don't take the trade. Not a smaller stop, no trade. And the same sequence works upside down in a downtrend. Line above price connecting the lower highs, extend it right. Look left for the old support that's now going to act as resistance. Wait for price to rally into the zone. Look for the bearish version of your tells a pin bar with a long upper wick, repeated failures to close above, or a sweep of the highs followed by a bearish engulfing close back inside. Entry on the close. Stop above the wick. Target the prior swing low. Minimum 2-to-1. Part 5. The confirmation trigger I promised you. Right. This is the piece I flagged at the start. Here's the problem with everything I've just described. Even a perfect confluence zone can be tested 3 or 4 times before it holds, and each of those tests can drag price another 20 pips lower. If you enter on the first rejection candle, you're often entering into the middle of the pullback, not the end of it. So how do you know the pullback is actually finished? You draw a second trend line, a small one, on the pullback itself. Think about what a pullback in an uptrend actually is. It's a miniature downtrend. It has its own lower highs. So drop down a time frame if you found the setup on the hourly. Go to the 5 or 15 minute and connect those lower highs with a short, steep line. Now you have a mechanical definition of the pullback. While price is under that little line, the pullback is alive. The moment price closes above it, the pullback is over. So the trigger stacks like this. Price is in your confluence zone, condition 1. A rejection or sweep has printed condition 2. The micro trend line over the pullback breaks and closes through condition 3, and that's your entry. Your stop still goes under the swing low of the pullback. What you've gained is timing. You're no longer guessing which test is the real one. You're waiting for the counter trend move to formally fail. Be honest with yourself about the trade-off though, because there is one. Waiting for the micro break means you enter later and slightly worse. On a fast move, you'll occasionally watch the trade leave without you. What you get in exchange is a much lower rate of being stopped out at the exact low before the move you predicted actually happens. If you're still building consistency, take the later entry every time. If you're experienced and you can stomach the variance, entering on the rejection candle gives you a better price and a worse hit rate. Neither is wrong, but pick one and log the results for 50 trades before you change your mind. Quick one before we move on. If this is landing, a like genuinely helps this channel reach other traders stuck at the same point. And if there's a pair or a concept you want broken down next, put it in the comments. That's where I get most of the video ideas. Part 6. The break play. Catching the turn without catching a fake. Now, the other side of the coin. A trendline break can be the earliest signal you get that a trend is finishing. But I need you to hear this clearly. A break of a trend line is not a reversal. It is a change of pace. Price can break a rising trend line and go sideways for 2 days at the same level. That's a broken line and an intact uptrend. So we need a filter, and the filter is momentum failure. Momentum failure is simple to spot once you know to look for it. In an uptrend, the market must keep making higher highs. So the warning sign comes before the break. Price pushes up, fails to exceed the previous high, and rolls over. Maybe it makes a double top, maybe just a marginally lower high. That failure is the market telling you buyers have run out of ammunition. Then, and only then, does a break of the line underneath actually mean something, because now you've got 2 independent pieces of evidence pointing the same way. Second filter. A break means a close, not a touch. A wick through your line is noise. On the hourly, I want an hourly candle to close on the other side, and ideally, I want it to be a candle with a real body, a decisive bar, not a doji that happens to settle a pip beyond. If your line is a zone, then a close beyond the far edge of the zone is what counts. This single rule will filter out a huge proportion of the fakeouts you're currently taking. And the highest quality version of this trade is the retest. Price closes below the rising trend line. Then, usually within a handful of candles, it rallies back up to the underside of that same line. The line that was support is now resistance. If it gets rejected there, you've got your short. And the beauty of it is, your stop is tiny, just above the retest high. That's where the big reward to risk trades live. Chasing the break candle itself is how you end up with a 50 pip stop on a trade that gives you 30 pips. Let me put the whole break sequence together on gold, because it's the cleanest way to see it. Say xauusd has been grinding up for 3 days, and you've got a rising line under the lows with 4 touches. Price pushes to a new high, stalls, and prints a second high at almost the same price. That's your double top and your momentum warning. Next, an hourly candle closes decisively below the trend line with a white body, warning plus break. Then price rallies back to the underside of the line, prints a long upper wick, and closes back below. That's your entry. Your stop sits above that wick, and your first target is the last significant swing low. 3 pieces of evidence, 1 trade. One more thing on fakeouts. Because they're not random, and they're not the broker hunting you personally. Look at where the stops sit. Under a well-respected rising line, there is a shelf of stop-loss orders from every trader who bought the previous 3 touches. That's fuel. A move down through the line triggers those stops, which creates the selling volume that lets bigger players buy. That's why the sweep and reclaim pattern exists, and why a break that immediately closes back inside the line should be read as a bullish signal, not a bearish one. Part 7. Top-down analysis. The map that keeps you out of bad trades. Everything so far has been on one chart. That's how most people lose money. They find a perfect 5-minute setup that's fighting a daily trend, and they can't understand why it keeps failing. So here's the pairing I use, and it's deliberately simple. If you trade the 5 or 15-minute, your context chart is the hourly. If you trade the hourly, your context is the daily. If you swing trade the 4-hour, your context is the weekly. And if you're a busy person trading the daily chart, your context is the monthly. The workflow is always the same 3 passes. Pass 1 on the context chart. What's the trend, and where are the major levels? Mark 2 or 3 horizontal levels, and if there's a clean one, the higher time frame trend line. Pass 2, back on your trading chart. Draw your line and find the confluence. Pass 3, wait for the trigger. Notice you only ever place a trade on the lower chart. The higher chart never gives you an entry. It gives you permission. And here's the rule for when the time frames disagree, because they will. If your hourly setup is long and the daily trend is clearly down into a daily resistance level, you have 3 choices. Skip it, take it at half size, or take it with a much tighter target. Treat it as a scalp back to the nearest minor level rather than a swing. What you must not do is take a full-size counter-trend position and then hold it, hoping the daily changes its mind. That single habit is responsible for more blown accounts than any bad entry ever was. Part 8. Risk, and the drill that makes this stick. None of this matters if the position size is wrong. Risk 1 to 2% of the account per trade, and let the stop distance decide the lot size, never the other way round. If the correct stop on your Go trade is $4 away, and that means a smaller position than you like, that's the market telling you, this particular trade is expensive today. Take the smaller size. The setup does not become safer because you want to earn more from it. 2 management habits worth stealing. First, don't rush your stop to break even. Moving it up the moment your 20 pips green Feels responsible? But on a trendline bounce, price will often dip back toward the line one more time before it goes, and you've just given yourself a scratch on a trade that was right. Wait until price has cleared the previous swing point, then move the stop behind that swing, not to your entry. Second, if you take partial profits, take them at a structural level, not at a round R number. The market doesn't know where your 2R line is. It does know where the previous high is. Now the drill, and it takes about 40 minutes. Open a chart, scroll back 6 months, and hide the right-hand side of the screen. Draw every trend line you can justify on the visible data and grade each one A, B, or C using the criteria from earlier. Then reveal the next 50 candles and screenshot what happened. Do that on 20 charts across 3 pairs. By chart 12, you will physically stop being able to draw C lines because you'll have watched 12 of them fail. That's not theory. That's pattern recognition built the only way it can be built. Recap and what to do next. Let's tie it together. 1. A trend line connects swing points and measures pressure. The angle tells you how much to trust it. 2. 2 touches is a hypothesis. 3 is a setup. 9 is a liquidity trap. 3. Only trade lines that arrive with a partner, a flip level, a big figure, a session high. 4. Never enter on the touch. Enter on the reaction, and use the micro trendline break on the pullback as your trigger. 5. A break needs a close and a momentum failure before it means reversal, and the retest is the better entry. 6. The higher time frame gives permission, the lower time frame gives the entry. Your homework this week is small and specific. Open your charts, delete every trend line that doesn't have 3 touches, and take one A-grade setup on demo using the micro trendline trigger. 1, not 7. Then come back and tell me in the comments how it went. I read them all, and the ones that come back with actual screenshots usually end up shaping the next video. If this made trend lines click for you, subscribe and turn on the bell. There's a new breakdown every week, and the next one goes deep on reading the pullback itself. How to tell a healthy retracement from the start of a reversal using nothing but candle size and structure. Thanks for watching, and I'll see you in the next one. And the usual, but it matters. This is education, not financial advice. Trading carries risk. You can lose more than you expect to, and nothing in this video is a recommendation to buy or sell anything. Manage your risk 1 to 2% per trade and test everything on demo before it touches real money.